Welcome to this explainer. Today, we're putting on our expert investment analyst hats and jumping right into an incredible valuation gauntlet. We are going to take a massive global financial heavyweight, Aon plc, and literally strip it down to its studs. We aren't just looking at a stock chart today. No way. We are systematically filtering this company's latest data through the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham before dropping it into a hardcore, modern, discounted cash flow model.
Here is our game plan for today. We'll start with a quick snapshot of Aon, followed by the Buffett, Lynch, and Graham lenses. Run a rigorous DCF analysis, and then wrap it all up with our synthesized final verdict.
All right, let's kick things off with Section 1, Snapshot. Aon plc.
So, what exactly does Aon do? Think of them as a massive professional services giant operating in over 120 countries, helping clients manage incredibly complex risks and human resources. Their core economic engine is absolutely driven by risk capital, which includes commercial risk and reinsurance solutions. That makes up almost 70% of their revenue. The remaining 30.5% comes from human capital, covering health and wealth solutions. They are for sure a global powerhouse. Looking at the Q1 2026 data, we're talking about a $78 billion behemoth trading around $312 a share. And they are churning out some seriously strong numbers. We've got $5.03 billion in Q1 revenue. That's a solid 6% jump year over year, fueled by 5% organic growth. But really, look at that bottom line. Diluted EPS shot up a staggering 27% to $5.63. Plus, they command a global workforce of over 63,000 employees, which actually grew over 7% from last year. This is a massive, highly active operation.
Let's move right along to Section 2, the Warren Buffett lens.
Now, we all know Buffett loves a wide moat and strong pricing power. Aon operates in what is essentially a global oligopoly, alongside just a few other massive brokers. Their incredible 39.1% adjusted operating margin, which is up 70 basis points from last year, by the way, absolutely screams competitive advantage. They have incredibly consistent earnings, posting their fourth straight quarter of 6% or higher organic growth in commercial risk. And for Buffett's absolute favorite metric, owner earnings, Aon generated $363 million in free cash flow in Q1 alone. That is a 332% year-over-year increase. When we actually run Aon through Buffett's strict checklist, the results are super telling. Wide economic moat? Definite pass. Consistent ROE and margins? Pass. Honest and able management? Well, they just repurchased $500 million of their own stock in a single quarter, and Buffett absolutely loves that. But that $14.7 billion long-term debt load, that's a heavy anchor and something Buffett would scrutinize very, very closely. Overall, Buffett would love the business economics here, but remember, he usually demands a 15 to 20% discount to intrinsic value before he buys in.
Okay, Section 3, the Peter Lynch lens. Lynch was famous for categorizing every single stock he bought. He would instantly label Aon as a stalwart. This isn't some hyper-growth startup that's going to triple overnight. It's a giant, mature company that still consistently delivers mid-single-digit organic growth and double-digit EPS growth. Stalwarts are those reliable compounders that act like a rock in your portfolio, protecting you during recessions. Lynch's holy grail metric is the PEG ratio. If we take Aon's forward PE of roughly 16.3 and divide it by their projected EPS growth rate of 11.8%, we get a PEG ratio of 1.38. Since Lynch generally targets a perfect 1.0 for growth at a reasonable price, it tells us you're paying a slight premium for Aon's growth right now.
Lynch also loved tracking the smart money, and institutional activity here is, well, violently mixed. Recently, 525 funds added to their positions, while 596 decreased. Dodge & Cox practically backed up the truck, buying over 4.3 million shares and essentially doubling their position. DZ Bank bought over 2.3 million. But on the exact flip side, UBS dumped almost 4 million shares. The smart money is completely divided on whether Al-Anon has run too far, too fast.
Up next, Section 4, the Benjamin Graham lens.
Graham was the undisputed father of value investing, and his defensive checklist is notoriously strict. Interestingly, Aon clears almost all of his defensive hurdles. Adequate size? Easily. Earning stability? Yup. Dividend record? They just hiked it 10% to 82 cents a quarter, marking their sixth straight year of double-digit dividend growth. Moderate PE? Yes, 16.3 passes Graham's sub 15 to 20 threshold, but it stumbles hard on the price-to-book metric.
And here's a fascinating quirk of modern finance. Because Aon so aggressively buys back its own stock, their book value is heavily distorted downward to just $46.62. It's wild. The very thing Buffett loves is the exact thing causing them to fail Graham's test.
Let's actually run the math on Graham's famous intrinsic value formula so you can see exactly how a classic value investor prices this stock. We take the square root of 22.5, multiply that by the annualized Q1 EPS of $22.52, and then multiply by that distorted book value per share of $46.62.
Graham's strict mathematical formula spits out an intrinsic value of about $153. Just let that sink in for a second. At roughly $312 today, Aon is trading at more than double what Benjamin Graham would consider its baseline intrinsic value. For Graham, this is a complete no-go. It lacks any margin of safety whatsoever.
Let's leave the qualitative guru philosophy behind for a moment and jump into Section 5, DCF and alternative models.
Because insurance broker cash flows are inherently seasonal, we can't just multiply Q1 by 4 perfectly. But if we construct a base projecting roughly $1.45 billion in normalized free cash flow and apply a 2% perpetual terminal growth rate representing standard long-term economic expansion, we can discount those future cash flows back to today. For a stable, highly predictable giant like Aon, we'll assume a standard 8% weighted average cost of capital, or WACC.
Valuation is never a single perfect number, right? It's a range based on your assumptions. In our base case, using that 8% discount rate and a 2% terminal growth rate, we generate a fair value of roughly $400 per share. Even if we decide to be more conservative and use a 9% WAC, the value still sits around $360.
When we cross-reference this with alternative models, the story really holds up. A dividend discount model factoring in their $3.28 annual dividend, growing at 10% historically, points to significant upside. Plus, the modern Wall Street consensus median target sits at $401.50, while the financial platform ticker models a mid-case of $451. Literally, almost every modern quantitative model points to a fair value firmly above the $400 mark.
So, what does this all mean? Let's pull it all together in Section 6, Synthesis and Final Verdict.
You can clearly see the divide here. Modern cash flow models and Wall Street analysts view Aon as deeply undervalued, pricing in that massive economic moat, the nearly 40% operating margins, and the future cash generation, giving targets ranging from $400 to $450. But Graham's strict asset-based formula, tied heavily to book value, rejects it completely at $153. Before making any calls, we have to weigh the realities. The strengths are undeniable. 5% organic growth, massive operating margins that are somehow still expanding, and free cash flow that rocketed up 332% year over year. But the risks are real too. That $14.7 billion long-term debt anchor is pretty heavy in a higher rate environment. There's also some noted softness in their U.S. wealth advisory demand. And exactly as Graham pointed out, you are definitely paying a massive premium on a price-to-book basis.
Here is the final playbook based on our expert analysis today. The quantitative and DCF models scream buy, seeing massive upside toward a $400 fair value. Peter Lynch would likely view this as a classic hold. Its stalwart status is fully intact, but with a peg of 1.38, it's not exactly a pounding-the-table bargain. Warren Buffett would love the business economics, but would likely wait for a 15% market dip to scoop it up and boost his owner yield. And the value purists? Following Benjamin Graham, they would walk away entirely, demanding a catastrophic drop to $153 before they'd even consider it.
So, the ultimate question you have to ask yourself as an investor is this. In today's modern service-based economy, do you pay a premium for a dominant economic moat and massive cash flow generation, or do you wait for the absolute hard asset safety of Benjamin Graham? There isn't a single right answer, but by filtering the raw data through these brilliant frameworks, you now have the exact tools to make a highly informed decision on Aon. Thanks so much for joining me on this explainer, and remember, always keep questioning the numbers.